Yeah, like I say, you can't make it work out to the exact percentage point, but I'm aware of that. So don't expect 50% of the final exam to be over internal sustainable programming. Okay? Yes.
How much time do we have on the phone?
On the final, you'll have 2 hours, I believe, what I have it set for. It's probably like 35 questions. So I'll have to look and I'll let you know more specifically when we get closer, but something along that lines. Other questions? Other questions? Okay, then let's go ahead and continue. Okay, moving into the last part of the course here, we're going to do Chapter 8, I think it's Chapter 8, 11, no, sorry, Chapter 8, 12, and 13, which are all kind of the investing chapters. And we're going to be pretty much doing a little bit here and a little bit there. So kind of look at them all as one big chapter. Chapter 8 is about valuation. Chapter 12, we talk about risk. And then Chapter 13, we look at some portfolio characteristics. If we have time, I have some derivative stuff that I'd like to do with you at the end of all this. But Chapter 8 is on valuation, and what we've done up to this point, as it's kind of putting everything together, is we've gone through the basics of the financial statements. We've been looking at everything from the corporate standpoint. Okay, so we've gone through the basics of the financial statements leading up to the creation of value. Okay, so we were projecting financials, deficit financing. We talked about leverage, where, you know, if you thought your sales were really going to be increasing, you'd want to hit leverage, so forth and so on. So now we're looking at things from the investor's standpoint. And in terms of investing in stocks, and I always think about the Young Investors Club when I start thinking about this, but in terms of investing in stocks, really there's two broad ways that you can approach it. I mean, we can talk about a lot of, you talk to 100 investors and you're going to get 100 slightly different approaches to investing. But I think the two broad ways of approaching investing is from what's called a fundamental standpoint, so fundamental analysis, and so-called technical analysis. Okay, fundamental analysis and technical analysis. Fundamental analysis is consists of looking at the underlying financial position of the firm. Okay, so this is where we're going to actually go look at the company to see how well they're doing financially. All right, and make our investment decisions from that standpoint. For example, if we're looking at a company and that company is losing money, then generally speaking, would we want to invest in that company? Well, probably not, but keep in mind if it were a brand new company, like all the dot-com stocks were back in the 90s, none of them were making money, yet their stock prices were going through the roof because people were speculating. You're going to hear that word for the next 2 weeks. People were speculating that one of those companies was going to be the next IBM. So even though they weren't making money right now, they were hoping that they'd be making a lot of money in the future. Okay? So that's kind of the fundamental approach to investing. The technical approach to investing is looking at past prices. Basically, I mean, there can be more to it than that because you can get the market internals. But it's basically looking at past prices for patterns that repeat. And then making your investment decisions off of that. So for example, if we were looking at a stock and the stock price looked like that, okay, and we were right here at this point in time, then of course what we would be looking to do is buy in anticipation of the stock doing that. Okay, so that's a 60-second summary of technical analysis. Okay, so again, two big picture approaches. Within fundamental analysis, we could break it down into two more approaches. One would be value investing, and the other would be growth investing. Again, we could talk about, you know, there are lots of things. I mean, this is a big part of what your investment analysis course was about. Value investing versus growth investing, and it's kind of, I don't know, I mean, I always have trouble coming up with a clear-cut definition distinguishing these two, because they kind of go together, in my opinion. But value investing is looking at the value of a company now versus this company's stock price. Okay? So if you think the stock price is below what the company is really worth, then of course you would be buying the stock, and vice versa. Okay, so that's kind of the gist of value investing as opposed to growth investing, which would be what?
Buying solid companies that offer consistent dividends.
Okay.
It's based on forecasting.
Joe, wait,
Forecasting,
what about forecasting?
when you forecast, you expect the economy to be better.
Well, all of this, and that's actually my point of this, is the common denominator in all of this is forecasting. Okay, which is why, you know, we started talking about it a little bit. We're going to talk about it more as it comes up over the next few days. But really, all of this is forecasting. Even companies, well, they pay a consistent dividend. Okay? Well, because they paid a consistent dividend in the past, you're speculating that they're going to continue to pay that dividend in the future, which may or may not happen. Okay, but with growth companies, I think probably the best way to look at this are these are companies where sales are growing, maybe not exponentially, but growing at an abnormally high rate, such as IBM, you know, when they were really in their innovation stage. Hopefully they'll be back into their innovation stage, I'm hoping. Okay, but you guys know from your more general business classes that companies go through, what is it, introductory, and then growth, and then maturation, and then what's the final one called?
Decline.
What's it?
Decline.
Decline, yeah, again, I'm operating on one ear here. Decline, so, you know, when they're really in their hyper-growth stage, all right, that's the, I think that's what we're looking at with growth stocks, okay? So, again, these are the big picture. I mean, we could start dividing technical analysis, we could start dividing each one of those, but notice that with value and growth, we have a dilemma, because let's say that we think a stock is worth 50 bucks, okay, and let's say that it's trading at 60 bucks. Well, our immediate dilemma is, if we're a value investor, what are we going to be looking to do with that stock?
Short.
Sell it. But if we're a growth investor, we would actually be looking to buy it. Okay, there's an old saying, expensive winners outperform cheap losers. Okay, so if this is a growth company where they're expecting a hyper growth in sales, then we would actually be looking to buy this. But even then, we still have to discount the future. Okay, so I mean, I'm giving you these broad definitions while at the same time disclaiming it that, you know, there's kind of some gray area here where we could dispute it. Okay, but what we were just doing with the financial statements was really aimed in this direction here. Okay, and Chapter 8 talks about value. I believe we've talked about this a little bit because there are different types of value. So as a reminder, what's book value? Final exam review. Book value. Okay, this is the value of the company. Final exam review. What is book value? Book value of a company. What do we mean? Yeah, book value of a company. Come here.
Is it the value of the company if we were going to sell it now? We were going to just liquidate everything?
No.
No.
Okay, now this is important. I assume that in your investing class, maybe you didn't, I don't know, but I assume that in your investment class you talked about the importance of the market to book ratio, or book to market. I can never remember, because the academics flip it around, I can never remember which one is which, but it's still the same ratio. I assumed you talked about the importance of this. If not, I'm going to remind you about it in a few minutes. Okay? Well, that's the market value of a company divided by the book value of a company. So what is the book value of a company? Just
It's the value the company holds for, which is the historical cost minus the depreciation of salvage value.
Okay, how about the value as carried on the financial statements?
Yeah.
Okay, so the book value is simply the value of the company as carried on the books, which is to say the financial statements. Okay. And we've spent quite a bit of time talking about the issues related to that. Okay. How about liquidation value? What is liquidation value?
The amount you would get.
Okay. This is what you would receive if you
You
actually
liquidate.
liquidated the company. The amount that you would receive if you actually liquidated the company. The problem with this is we don't know what this value is until after we liquidate the company. Okay? So what we tend to do, or at least what I've seen done a lot, whether it's right or wrong, is we tend to use book value as a proxy for liquidation value. Which, in my opinion, is one of the main reasons why this ratio is important. Okay? Because, just for the sake of conversation, let's say that we'll keep the number simple. Let's say that the market to book ratio of a company is 0.6. Well, if that were the case, what would be the opportunity here? It'd probably be difficult to pull it off, but at least theoretically, and in some respects, realistically, what would be the opportunity here?
I guess to go long, because you're saying that the value of the company is 60% of its market value, so you
Well,
buy.
yeah, I'm not saying that, but what I am
Yeah.
saying is that what we tend to do is use the book value as a proxy for the liquidation value. So if we could actually liquidate this company at $100 a share and buy it for $60 a share, then the opportunity is we take over the company.
Yes.
So we buy up all the stock, or at least voting control of the stock for $60 a share, liquidate the company, sell all the assets, pay off all the liabilities, and we make a 40% profit. Now, that's going to be difficult, not impossible, but difficult to do in real life. Okay? But that's the opportunity, and I think that, you know, in your 3-factor or 4-factor model that I imagine you saw somewhere along the lines, I think that that's why this ratio is important, at least on the low side of the price. You know, the high side we can kind of talk a little bit, but I think that's why it's important on the low side. I mean,
I never understood what is the reason that this happens. Why would the company allow it to go that low, even
it's
though?
not the company doing it; it's the market that's doing it. And I mean, yeah, I understand we're getting a little ahead. So let me give you a short answer now, and we'll get more to that in a few minutes. But understand, in fact, if you don't understand anything about the stock market, understand this: it's forward-looking. Okay. So that's what you hear the market referred to as a discounting mechanism. It doesn't care about what's happened in the past. It's looking forward to what it thinks is going to happen in the future. Okay. So if this company is getting ready to go under, then it may very well drive down this price. Okay? Because next year, for example, the market's book may look like that. Why? Because the company's getting ready to go under.
Ah, I see.
Okay? So the market is forward-looking. That would be the argument, which is actually an insightful comment, because what I said here presumed that this is actually going to hold.
Yeah.
Well, if they're bleeding money, then that probably doesn't hold. Okay? All right. Of course, we've got fair market value, which is what's fair market value? Okay. How about the price that an asset would change hands between a willing buyer and a willing seller? Probably ran across that in economics. Okay. Price that would change hands between a willing buyer and a willing seller, such as most of your stock quotes that you see. You know, you look at a stock and you might see a price of $58.33. Okay. Well, that's what the let's, looking at it from the buy side, we'll say that's what the specialist is willing to sell it for at this particular point in time, okay? You got to be careful because in some of your quotes, I should have thought to bring it up before class, but my thought is on my ear right now. But you got to be careful with some of these quotes in the stock market because usually what this represents, by a lot of times, what this represents is the last trading price, not necessarily what you can get right now. And especially in thin markets, you got to be real careful with this because this last trading price, we were talking about, Tommy was kind enough to give us one of his trades earlier in the semester, it hadn't traded for a couple of days. Okay? So this might be what we call a stale quote. Right? It was the trading price from 2 days ago, but it's not what you would get now. I mean, the market now might be $45, or it might be $75. Okay? So you got to be a little bit careful with the quotes. But in any case, the last value, and I'm sure we talked about this earlier, is intrinsic value, which is the present value of future cash flows. Okay, so I think all other things aside, I think it's convincing that the intrinsic value of the company is its real value. Okay, you guys know the intrinsic value. So cash flow at time t. Let's see, t goes 1 to, we'll say n plus r. Okay, so this is simply the present. Excuse my ugly writing there, but this is simply the present value of the future cash flows. So theoretically, what we could do is to simply calculate the intrinsic value of a company per share, compare it to its actual trading price, and if it's undervalued, we buy it. If it's overvalued, we sell it, which is, of course, value investing. Well, I don't have to tell you guys a whole array of problems with this. First of all, starting with forecasting the cash flows. Because we're going to have to know the amount of the cash flow, and we're going to have to actually know the timing of the cash flow. And we'll get back to that in a minute. I think another major problem here is identifying the appropriate discount rate to use. Okay? Even if we know the cash flow, even if we know what the cash flow is, how do we go about identifying the appropriate discount rate to use? What do you guys think? You understand where I'm at, right? Oh, present value, future cash flows. So even if you know the cash flows from a company like the dividend stream, for example, then how do we know the appropriate discount rate to use? Or at least what approach, Elena?
I think that it's gonna be different for every investor.
Why? Oh, every investor?
Yes.
Okay, why?
Because I may expect high return. If yours is lower, maybe you have to consider your required rate of return.
Okay.
Consider mine.
Okay. Yeah, and by the way, forgive me if I'm looking at you funny. I'm listening out of my left ear because I got ringing going on this ear, so I'm really trying to focus. So I'm not. That's why I'm doing that. Somebody help her out.
I was just thinking that IRR is different for each company.
Okay.
Did you go off like the last trade, kind of like bonds?
But what would we use off the last trade?
Basically how the last investor kind of discounted the rate. So if you knew the cash flow, now is it coming in the time?
Okay. Tony.
Well, wouldn't you be using the risk-free rate, but then you have to go ahead and forecast that based on government policies and what you think the government's going to do and the Fed?
Yeah, and I think that's related to Elena's. So yeah, hold that.
I was just going to say cap M.
Okay. Well, yeah. All right. So kind of putting all of that together, putting all of that together. This is going to be based on your required return. Okay. Well, and by the way, I had a note in my notes, and I meant to look it up, and I got distracted and forgot. I don't remember what your book says about expected return, but I have a note in there that I take issue with their definition of expected return. So let's pause that conversation 1 second. What's the difference between expected returns and required returns?
The expected return is what you will expect to get from that investment. The required return is the minimum you'll accept in order to invest in it.
Okay, yeah. Somewhere along, if you had me for 34.3, you've heard this before, but somewhere along the line, I learned that when you're defining a word, you never use that word in the definition. It's kind of hard in this case. But the expected return is the returns that you
Hoping to get.
anticipate from the forecasted future cash flows. Okay, what you anticipate making from the investment, as opposed to the required return, which is the minimum return that you would accept to purchase the investment. The minimum return that you would accept to purchase the investment. Okay? Now, over here in calculating intrinsic value, what we're going to use is our required return. Well, as has already been pointed out, the required return consists of two components. What I think is very unambiguous is the first part of this. What is absolutely going to fit into the required return? What is one thing that's absolutely going to drive every investor's required rate of return? The risk-free rate. The risk-free rate. You guys all know by now that there actually is no such thing as a truly risk-free rate. Okay? But you guys are also aware of the proxies that we use, T-bills, CDs, so forth and so on. I kind of hedged a little bit on your answer, Tony, because I think at any given period, the risk-free rate would be what's available at that period. So if we're looking to invest over the next month, let's say, then we could buy 1 month T-bills right now, basically speaking. Or, if we're looking at a year, we could buy 1 year T-notes right now. So that's the rate that's available right now. What the 1 year rate's going to be a year from now is another conversation. Okay? So clearly, the risk-free rate is going to drive required return. The other part will be the risk premium. The risk premium. Okay, so if CDs are yielding 2%, and I am offering you a risky investment with an expected return of 1%, is anybody in here going to take that? Okay, good. Now, in 34.3 I get different answers, but graduating finance majors, I hope you wouldn't take that return, that investment. Okay. So I'm going to have to offer you at least 2%, but in reality, I'm going to have to offer you more than 2% because my investment contains risk. So, and then that starts getting us into conversations about, well then, what is a fair risk premium, which is CAPM, which we're getting ready to get back into in a second. Okay, so what I'm getting at here is that this required return is going to take into account these variables, and notice that in the variables we've talked about opportunity cost, okay, my 2% CDs. Of course, inflation is going to be captured in this required rate of return. I mean, if you expect inflation to be 3% next year, then rather than purchasing an investment with 2%, you would actually be better off buying a whole bunch of cans of corn and sticking them in your cupboard for a year. Because in terms of the purchasing power, your real rate of return would be higher. Not that I've ever done that, nor do I plan on doing it. You have to buy a lot of corn to make that. You might argue that the gas to get you to the store would eat up all your profits there, but But in any case, inflation is going to be in there, and of course, risk.
OC?
I'm sorry?
OC?
Risk.
No, opportunity cost.
Opportunity, opportunity cost. Opportunity cost. Okay, so far so good? Okay. All right, then let's take a look at risk. All right, so like I said, we've got a lot of variables here, but just focusing in on risk, which is going to be a key component of valuation. In fact, in finance, we argue that's probably the most important variable for valuation. That's what, while we're on the subject of your 3 and 4 factor models, we talked about market and book. You guys also know that the other variable in there is small minus large, I believe it is, which is the size variable for explaining stock returns. What's the rationale behind that? This is a pop quiz. I gave you my rationale behind market to book. What's the rationale behind the argued fact or the argument that the size variable of a company helps to explain that company's return? Say again? No, I wouldn't say that. I wouldn't say that. Because smaller companies are more risky than larger companies, at least on average. Smaller companies are going to be more risky than large. So this is capturing risk. Right? Smaller companies more risky than larger, therefore we would require a higher return out of those companies. And that becomes important. In fact, that's why this whole model exists, or well, a big reason or big use of this 3 and 4 factor model, the reason it exists is as an appropriate benchmark. Okay, if you're trading small caps in your account and you're comparing the performance of your account to the S&P 500, then arguably is that a fair comparison? No. Well, I'm trading small caps and my account was up 15% last year and the S&P was up 14% last year. Does that necessarily mean that you beat the market? No, because small caps are more risky. Therefore, you would expect to be, it's a risk premium, you would expect to be compensated for that additional risk. And that's the argument here, is that the outperformance of those stocks is just compensation for bearing additional risk. In the 3403 book, over time, and I think this is going back to like 1926, you guys have seen these numbers, large caps averaged around 12%, small caps averaged around 16%. The argument there is, yeah, that extra 4% is a risk premium for bearing the risk of smaller, less established, less known, more risky companies. Okay? All right, so far so good? Okay. They give you this graph in the book, and I wanted to throw this up for your discussion. I'm soliciting feedback from you guys because you've seen this before in terms of trying to create risk profiles of investors. Right? And I always get a kick out of these conversations because I can tell you from personal experience, and you can believe this if you don't believe anything else you hear this afternoon, and that is that people's risk profile changes after real money's put on the table. Before they open their account, you know, you can give them the questionnaire, and you can go through all this kind of stuff, and that's all well and good, but after real money gets put on the table, their risk profile changes. And then when they go through the inevitable drawdown period where they're losing that money, it changes again. And then when they start making a lot of money, it changes again. But what you've seen before are, let's say, 4 investors here, A, B, C, D, straight out of your book. Investor A, what would they be considered in terms of their risk profile? Risk averse or risk seeking? would they be risk-seeking? Glad we're having this conversation.
Because their required returns higher than the other people
It
as.
says,
Yeah, which
as
therefore
his
would
ri-
make them,
As his risk goes up, his required return goes up. So,
We can make them risk averse.
it would make them risk-averse. Because if you have a more risky investment, then their required return is going to be higher. So risk aversion doesn't mean that they won't take risk. It just means that they got to be compensated for it. Okay? So A would be considered risk averse. What about B?
still risk averse, but less.
Yeah, B is also risk averse, but B is less risk averse. Because this person still demands to be compensated for risk, they just don't require as much. Okay. What about C?
Doesn't care.
I beg your pardon?
Doesn't care. Either one.
Okay, doesn't care. Risk neutral. Risk neutral. Really, the reason I threw this graph up there is to talk about D.
Stupid.
Well,
It's a monkey. Making bets.
yeah, what your book argues, and others as well, I'm not picking on your book, but how does your book classify D? No, they're not risk averse, they are risk seeking. Because they're actually looking for more and more risk, even though they require less return for that. I mean, I would argue more along the lines of, I'll be professional, irrational.
Risk-loving gamblers.
Yeah, yeah, and I mean, I would even argue that risk neutral are gamblers, because they'll, I mean, in more of the literal sense of the term, they'll go play poker or roulette or slots or whatever all these other gambling things are, regardless of the risk. They're just doing it for the fun. Yeah. So, but like I say, really, what I wanted to throw this up for your consideration with respect to D. So other comment, because like I say, I assume you've seen this in other classes before. Other comments about risk seeking. Okay. All right, now let's see where we're at. So risk averse, neutral seeking. Good exam question. There's your chart. What is investor B considered? Risk seeking, risk neutral, risk averse, but not as risk averse as A. Risk averse, but more risk averse than A. Okay. So you narrow it down to 2, and then you guess one. By the way, exam test taking tip, if you're not sure of the answer to a question on the exam, there's nothing wrong with guessing. Okay. I mean, eliminate the choices that you know aren't the answer, but if you can narrow it down to at least 2 or 3, there's nothing wrong with guessing, so don't leave answers blank on the exam. Okay. All right, so questions about risk while I figure out where we are. Questions? Okay. So with respect to this risk premium, one of the ways, this was mentioned a few minutes ago, one of the ways that we can attempt to measure a proper risk premium is through the capital asset pricing model, which is, I'm not going to do that to you. You guys all know what the CAPM is by now, I hope. Capital asset pricing model. Just for my own curiosity, I'm not trying to I'll do it the other way. How many people have talked about the CAPM before? Okay, I'm actually looking for people who aren't raising their hands. How many people have not? I'm not trying to embarrass you, but I hear conflicting things about prior courses. So everybody's at least seen this before? Okay, good. So you guys know what this is all about, but what I wanted to emphasize to you is two things. One is the original intent of the CAPM. The other is the more useful use of the CAPM. What was the original intent of this model? And as you know, this is the starting point for your 3 and 4 factor, which I was just alluding to down here. But kind of going back to the basics for a minute. What was the original intent of this model?
We took forecast rates.
Yeah, the original intent of the model was to actually forecast future stock returns. Well, for that purpose, I imagine you guys have all either been taught or concluded on your own or both. For that reason, it stinks. I mean, forget it. Okay? For a number of reasons, I think we're okay on the risk-free rate for what I just talked about a few minutes ago. But in order to forecast returns, using this model, what would we have to do? We're okay on the risk-free rate, but what else would we have to do?
Determine our beta.
Okay, we'd have to determine the beta. And I'll get back to that in just a second. Well, we'll do that right now. We've got to determine the beta. What's the problem with that?
It uses the past 12 months or whatever.
Historical data.
What's the problem with that?
What's the problem with that?
Yes.
That's in the past, it's historical, it
True, but
doesn't provide. a
all
forecast,
forecasting starts with history.
But it doesn't forecast.
Okay, somebody help me out. What's the problem we face? And this is actually one of the spreadsheets we're going to do. We're going to look at this. We're going to replicate how this was tested on a basic level. And you see beta all over. You get a brokerage statement, you see beta. You pull up your finance sites, you see beta. Okay?
No, what I was gonna say, would it be because you're assuming that it's gonna be the same?
Okay, close. Yeah, betas have been shown, and one of our spreadsheets shows this as well, that betas have been shown to be very unstable. Okay, so 1 year your stock's beta, or your portfolio beta for that matter, might be 1.3. The next year it might be 0.8. The next year it might be 0.3. The following year it might be 1.5. Okay, so they've been shown to be that beta's been shown to be very unstable. All right, and we're going to look at a couple of what I consider key studies that showed that. Okay? Because again, you pull up your Yahoo Finance or pretty much any of your websites, and you're going to see CAPM information. Okay, well they show on there a beta of 1.3. Well, that's all well and good, but first of all, they've been shown to be unstable. But second of all, what was the look-back period for setting this beta? 1 year, 2 years, 3 years, 5 years, 10 years? What time interval were you using in the data? Were you using monthly prices, weekly prices, daily prices? Because all of that would give you different betas. Okay? So our big challenge with beta is the instability of it, I believe, which we'll see on our spreadsheet. But also, if we're using this to forecast returns, what else are we going to have to do in addition to beta? Market. Yeah, we got to forecast. In fact, if you really wanted to write it correctly, we got to forecast the beta, like we just said. And there are forecasting methods for trying to forecast beta. We'll look at that at a macro level at least. But we also got to forecast the overall market. Now, theoretically, what investments are in this market portfolio? Theoretically.
Every company.
Everything. Yeah. Theoretically, everything is in there. Okay? Stocks, bonds, stamps, coins, antique cars, everything. Well, even in today's computer world, we would have trouble getting our arms around everything. And even if we did, it would probably be too late to really be useful. So for that reason, we use proxies for the market portfolio. Probably the most common is S&P 500. But I just gave you an example of a situation where that would not be appropriate. If your portfolio is all small cap stocks. The S&P 500 consists of large cap stocks. So that wouldn't really be appropriate, and that's one of the big defenses of the CAPM. If, final exam question, maybe, if you are using this model, so you're using the S&P 500 as the proxy for the market portfolio, but you're comparing it to your account that consists of small cap stocks, and therefore your equation's out of balance, basically, which is to say your account is either over or underperforming the market. That's an example of what type of error. What type of error? And this is actually the main reason I'm showing this to you guys. Benchmark error. Okay? It's called benchmark error. We're not using the appropriate benchmark. Okay? That's something I'm going to be busting the Young Investors Club's chops about here before long when we start trading some money. Is what benchmark are we going to use to determine how well we're doing? Okay, and that's one of the big defenses of the CAPM is, you know, to the extent we get evidence showing that the capital asset pricing model isn't any good, then the old school proponents of this will say, yeah, that's because of benchmark error. If you actually could measure the market portfolio, then this would hold up. I don't subscribe to that, but some would. Okay? In my opinion, more importantly than all of this, to use this to forecast stock returns, one of the things you're going to have to do is to forecast the market portfolio. S&P 500 is a proxy for the market portfolio. If you can actually forecast the S&P 500 with any accuracy and consistency, then you don't need any of this stuff. You can go make more money than your grandkids will spend. And I mean that literally. Okay? So again, the original use of this, forecasting, stinks. Questions? Questions? Okay, the second use of it is for performance evaluation. Okay, and in this case, I think that it does have value. You know, again, there's more to it than this. We need to throw in our book to market. We need to throw in our size. We could argue we need to throw in the momentum variable for our Carhart 4 factor. That's kind of another conversation. But again, going back to the beginning, I think there is value in using this for performance evaluation. Because looking at last year, let's say, well, we know what the returns were last year. We know the risk-free rate that was available last year. Through the process of linear regression, we know beta last year. We know the systematic risk that we accepted last year. We know what the return on the market was last year. Okay, so this is actually a linear regression model like we just finished doing in forecasting. What is our performance measure here? What's it called?
Expected return?
No?
Oh, alpha?
Outstanding. More specifically, Jensen's alpha. Okay, because notice that the capital asset pricing model, now this is looking backwards. This is looking at history. This is performance evaluation. Our capital asset pricing model is giving us our required return. And we can get into, I just made a big deal about required versus expected, and we can get into a little bit of semantics there. But I'm not gonna get hung up on right here whether you would call this the required returns or the expected returns. Okay, it kind of depends on the question. But the required return, and we're comparing it to our actual returns. What the CAPM says is that these variables completely explain a stock's return. Therefore, alpha should be 0. Right? If the CAPM held, alpha should be 0. Well, you guys also know alpha ain't 0. So alpha is simply, I mean, all of this said another way, alpha is simply the difference between our actual return and our required return. So of course, if alpha is positive, then we have, or the stock has, outperformed the market. Okay? If it's negative, it's underperformed. Okay? The nice thing about this is we can also start applying statistics. Okay? If our alpha ends up being 0.000000001, it's positive, but using your statistical common sense, have we really reliably outperformed the market? Probably not. Probably not. Okay? And all of that is simply linear regression. Okay? So I'm reminding you of this for a number of reasons, one of which is you see the CAPM information everywhere, so you're going to have to, assuming you're in investing, and even if you're not, because even in the corporate world, when you're determining cost of capital, okay, well, what's one of the major models there? CAPM. Okay? But also, what I started working with some spreadsheets, and hopefully I'll be able to incorporate them into everything. In addition to using the market, I'm also going to show you a couple of other benchmarks that you could use to assess your performance. Okay? So that's really just a reminder of all that, which, by the way, I got a little out of order here, but that is what this is all about right here. This tab, the cap in cap. That's what this is all about. Okay? So tomorrow, and by the way, I just updated this spreadsheet today. I'm working on some things that I'm trying to stuff in there. So I updated this today, but I may have other updates as we go on. So right before class, you might want to hop on there and check to see. Well, let me put that another way. If I update it, I will most assuredly have it updated by noon. So check around noon or thereafter. Okay? All right, questions about any of that? Questions? Okay, then I'll go ahead and pull the plug